Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Good day, everyone. Welcome to another Cambridge podcast. I hope that all of you are doing well. It's 2018 tax season, and I have been very busy doing tax planning and taxes for many of my clients. And today I want to take a few minutes and kind of talk about some of the things that my clients are asking me pretty much daily every time I do a review and or I do a tax return for a client or do some tax planning. You know, questions like how much money can I contribute to an IRA and still be able to deduct it for 2017? What are my deductions now in 2017 compared to the new tax law? What are the deductions in 2018? How much do you think may be the most suitable way to make contributions to a qualified plan? I do have a 401k at work. You know, how's that going to work moving forward and so forth? And then obviously, you know, when people start thinking about distribution of assets out of their qualified plans, many of the questions that I'm getting deal with, you know, should I take all my money in a lump sum? Should I take a little by little? Do I roll it over to another IRA? What are their tax consequences and so forth? So I'm just going to give you a quick overview of some of these questions and the answers that we have. Now, for 2017, obviously in 2018, you can still make a contribution to an IRA if you qualify to do so. But you must make that contribution no later than your tax filing date or April 15th for that matter. Now, traditional IRAs and Roth IRAs for 2017 and 2018, they really have not changed. So the most amount of contribution that you can make for 2017 to get credit for the 2017 year is $5,500, and the same thing will be in 2018. Now, you do have the ability to do a catch-up contribution if you happen to be age 50 or older, and that would be an additional $1,000. So if you're 50 years of age and older, you can make a total contribution to an IRA or to a Roth IRA in the amount of $6,500, which is $5,500 for the original contribution plus $1,000 for the catch-up. Now, if you happen to, and there are other plans like simple IRAs and SEP IRAs, I don't see as many of those, so I'm not going to cover those on this call. Same thing with the profit-sharing contributions and money purchase and, you know, some of the different pension systems that are available in the marketplace, and the numbers do change dramatically from one to the other. But traditional 401ks or SARSEPs or 457Bs, which are your governmental plans, the elective deferral for 2017 was $18,000, and then obviously you did have a catch-up contribution if you were 50 years of age or older, and the catch-up contribution is $6,000. So if you happen to be at least 50 years of age and you're still employed, you have W-2 income, you can make a qualified 401k contribution of $24,000 in total, of which $18,000 would be the original contribution plus $6,000 on the catch-up. Now for 2018, the $18,000 goes to $18,500, but the catch-up limit will remain at $6,000. So that's important to know from that perspective. Now, as far as the amount of taxes, Social Security taxable wages that you're going to have to pay for 2017, and that was in 2017 we had a big jump from 2016, but the Social Security taxable wage base in 2017 was $127,200. For 2018, it went up a little bit to $128,700. That means that For 2017, as you're prepared to do your taxes, up to $127,200, you had to make a contribution to your Social Security of 6.20%, and your employer needed to match that contribution. As far as the 1.45, which adds to 7.65 on the employee side, the 1.45 is for unlimited earnings under the tax code. So you could make $2 million in W-2 income. You will pay 6.20% up to $127,200, but you will pay the 1.45% for the entire $2 million of income. Now, something interesting to note is that as I discuss taxes and tax preparation with many of my clients, I do get a number of questions regarding the 1040 individual tax return. Now, most of the clients that I deal with file a tax 40 because they do itemized deductions and they take other credits that require them to file the long 1040 form. But I think it's critical to note several areas of the tax form that I think is very important for all of us to have a clear understanding on. Now, filing status, it's always one that comes to question. And one of the questions I get regularly is, does it make more sense for me to file married filing jointly, or is it okay to file married filing separately? You can also file single. You can file head of household if you have a qualifying person, and then you can also file as a qualifying widower. Obviously, there are some responsibilities and guidelines to abide by. It always works the very best if you're married when you have the ability to file married filing jointly. Now, there are also exemptions that you take. So, for instance, for 2017, now those exemptions went away for 2018, but for 2017, if you're married filing jointly, you would claim two of those for you and your spouse. And then if you have a child, you can add an exemption or two exemptions, so 3 exemptions for the children. I'll cover those exemptions in a minute. So if you have a family of 4, husband and wife and 2 children, you would then have a total of 4 exemptions to claim. Now, when it comes to income, we do get a number of questions regarding the different types of incomes. And the 1040 is very good in the sense that it breaks down the income depending on where it comes from. So on line 7, you have wages, salaries, tips, and that's primarily where your W-2 income is going to go to. Then on line 8, A and B, you have your taxable interest, you have a tax exempt, and then you go down the line. So from 7 to 22, line 22, you have all types of different reportable incomes that must be included. So if you're taking an IRA distribution, or if you're taking a pension distribution, then that will go under line 15A and 16A accordingly. Now, once you pass line 22, where you have all of your income and that would be the total income for the year, then you have what is known as your adjustable or adjusted gross income. And this is where we start to call the above the line deductions. And there are certain things that you're able to deduct above your adjustable gross income, or what actually makes up the difference between your total income and your adjustable gross income. And that's something that is very, very important, because your taxes are going to be based on your adjustable gross income, not on your total income. Now, what are some of the things that you can deduct under adjusted gross income, line 23 through line 37 on your 1040? Educator expenses, certain business expenses. If you have a health savings account deduction, you're contributing to an HSA account. you have the ability to deduct that because that goes on a pre-tax basis. Moving expenses, if they qualify. Deductible part-time or self-employment tax. If you make contributions to a self-employed SEP, which is a simplified employee pension or a simple plan, and other qualified plans. Self-employed health insurance deduction, you can take a deduction for that as well. You can actually take a deduction for any penalty or early withdrawals of savings. So let's say that you had a certificate of deposit that you needed to invade and liquidate prior to the time that it would expire. Obviously, the banking or the financial institution is going to charge you a penalty or a fee for doing that. You're going to have the ability to deduct that against your total income. If you have an IRA deduction, if you made a contribution to an IRA, you can also deduct that. What if you're paying student loans? You have the ability to take a deduction for that as well. And along those lines, you also have a deduction for tuition and fees and so forth. So you have your total income, which was line 7 through 22. Then from line 23 through 37, you have your adjusted gross income calculations, which will actually, once you deduct those, if you have any there, then you will arrive at your adjusted gross income. Now, once you arrive at your adjusted gross income, there are some additional deductions and credits that you may be able to take. On line 39A, one of the questions is, were you born before January 2nd, 1953? And if you're married filing jointly, was your spouse born before January 2nd, 1953? If the answer is yes, then you take an additional $1,250 per person along those lines. And if you happen to be blind, either one of you or both of you, if you're filing jointly, obviously you'll take that deduction as well. Now, line 40 is a very interesting one. And under the new tax laws, the new tax job act that was done at the end of 2017 by the Trump administration, we're going to start to see less and less people itemizing their deductions. And the reason for that is that line 40 gives you the ability to either itemize your deductions, and you do that on Schedule A, or you can take the standard deduction. Because of the fact that the standard deduction has gone up for individuals and head of household and married filing jointly and so forth, then there's a high probability that less people are going to be itemizing their deductions in 2018 and beyond than they had done previously. Now, for 2017, if you're single, your standard deduction is $6,350. If you're married, filing jointly, is $12,700. Now, for 2018, if you're single, it'll go from $6,350 to $12,000, and if you're married, filing jointly, it'll go from $12,000 to $700. But at least for 2017, married filing jointly would be $12,700 or $6,350 for a single individual. Now, line 42 deals with the exemptions. And the exemptions for 2017 is $4,050 per person. And that exemption is basically for being alive. So up until 2017, you were able to take your standard deduction if you were married, filing jointly, or single. Obviously, we just talked about those numbers. But on top of that, you were able to take an exemption for yourself. In this exercise, I said that this is a married couple filing jointly with 2 children, so there are a total of 4. So you actually take $4,050 times 4, and you add that as an additional exemption. Always remember that your itemized deductions or your standard deductions and your exemptions reduce your taxable income. So once you arrived at the adjusted gross income that we discussed previously, then you're going to deduct, if you're married filing jointly, the $12,700. You're also going to deduct the $4,050 times 4, so that would be $16,200. So you get to deduct that as well. And then obviously you will arrive at your tax number from a business perspective. Now, once you actually see the 1040, it becomes fairly easy to identify. So you'll eventually arrive under tax and credit. Now, something very important to understand is that deductions and exemptions reduce your taxable income, and that's what we have covered up until now. Your credits are reducing your tax liability. So, once you arrive at the taxable income, so if you were making $100,000 as a family of 4, and all of a sudden after taking all your deductions and exemptions and so forth and credits, you get to a taxable income of $60,000. Now your tax liability will be based on that $60,000. But you also have the ability to take certain credits, and I'm not going to cover them. I cover all of them here for you. But from line 44 all the way to line 56, there are a number of credits that you can take. I'll give you some. So, for instance, foreign tax credit. That means that if you did any work outside the United States, and you may have paid taxes in another country, so obviously you get to offset some of that as well. Credit for child and dependent care services. If you qualify, you are able to take a credit for that. Education credits. Retirement savings contribution credit. People don't know this, but if you're in retirement and you're still working part-time, or you have a side business, and you contribute, let's say you make a contribution to an IRA of $5,500, you can actually take an additional $1,000 credit, because it's a way for the IRS to reward you by continuing to make contributions to an IRA after you have legally retired from a business perspective. Now, you also have the ability to take a child tax credit, residential energy credits if you improve the energy in your home, and obviously there are guidelines that you need to follow on that. And then obviously now you're going to get to, you add all of those credits, and obviously they're going to reduce your tax liability from that perspective as well. Now, there are other taxes, like self-employment taxes. Let's say that you had a part-time job or you had an employment where you were paid a 1099 and no taxes were withheld. Now you have to start adding the self-employment tax back and so forth, or unreported Social Security, Medicare taxes along those lines. The same thing for healthcare from a business standpoint. Now, you obviously earned income credits are credits that you may be able to apply. You can apply an additional child tax credit. You can also apply for an American Opportunity Credit if you do qualify based on education or certain guarantees and certain things that students get from scholarships and so forth. So you take all of those, and then they become the total payments that you have made. And obviously, if you've made more payments into the IRS for the taxable year as opposed to what you should have made, then you get a refund. Otherwise, you may either break even, or you may have to pay some money back to the IRS. Now, what are some of the other tax deductions that are still available? Obviously, another key deduction is on reimbursed medical and dental expenses. Now, remember that you may only deduct medical and dental expenses to the extent that they exceed 7.5% of your adjusted gross income. That would be the above the line deductions and income that we discussed. And obviously, as long as they were not reimbursed by your insurance company or your employer. Now, the Tax Cuts and Jobs Act of 2017 reduced the threshold from 10% to 7.5% retroactively for 2017. So remember, under the old law in 2017, unless the total amount of your medical expenses did not exceed 10% of your adjustable gross income, then you couldn't take a deduction on anything below that level. Anything that exceeded 10%, then you were able to take a deduction. But the new law changed that for 2017 and 2018, so it did reduce it in 2017 to 7.5%. So anything over 7.5%, you're able to take a deduction from a business perspective. Now in 2019, the threshold will then increase to 10%. So at least for 2017 and 2018, the threshold is 7.5%. Now, home mortgage interest has several modifications. Interest on a home equity loan is no longer deductible. Interest on new home mortgage is limited to interest paid on a maximum of $750,000. Now that's for 2018 and so forth. Taxpayers with a mortgage taken out before December 15th of 2017 can obviously continue to claim home mortgage interest up to $1 million. So if you purchase a home prior to December 15th of 2017, then you're still under the old rules and you have been grandfathered accordingly. Now, personal casualty and theft losses are no longer generally deductible. The only exception is for certain losses in federally declared disaster areas. So, for instance, Florida with Hurricane Irma last year, or Puerto Rico with Hurricane Maria and so forth, and some of the issues that we have had in Texas. If the federal government declares that area a disaster area or zone, then you do have the ability to take certain deductions for losses. For 2017, the maximum is $5,000. Now, please make certain that you discuss this with your accountant, because I did last week 7 audits on clients that had already filed their taxes with another tax preparer, and none of that became a topic of conversation, and I think you're leaving money on the table. If you did have certain losses, you have the ability now to file Form 4684 and be able to get some of that credit along those lines. Now, the end of the year is a time to take one last good look to determine whether you qualify for a tax credit or a deduction, or whether you're close to the cutoff point. Now, always remember that you need to do tax planning prior to the end of the year, because when it comes to April 15th or April 17th, whenever taxes are due, depending on where the weekend falls, you have to pay the taxes then. So there's very little tax planning that you can do after the first of the year for the previous year. Now, most of the changes to itemized deductions will remain in place through 2025. In 2026, our understanding is that itemized deductions will generally follow the rules that were in place before the Tax Cuts and Jobs Act. So everything sunsets in 2025 unless Congress decides to extend it. So there's a tremendous opportunity for all of you on this podcast to be able to create a tax-free retirement life, and if you're able to do so, you have 8 years in order to make a lot of those contributions at a much lower tax bracket than we're definitely going to have sometime in the future. Now, another question is what's the most tax efficient way to take a distribution from a retirement plan? And if you receive a distribution from a qualified retirement plan, such as a 401k, you need to consider whether to pay taxes now or to roll over the account to another tax-deferred plan. Now, that's going to be a personal decision, but it's something that is very, very critical to understand. Now, if you decide to take a lump sum distribution, income taxes are due on the total amount of the distribution. Now, except for any after-tax contributions that you may have made to your plan. And the taxes, by the way, are due in the year in which you cash out your account. Employers are required to withhold 20% automatically from the check and apply it toward your federal income taxes. So you will basically only receive 80% of your total vested value in the plan at time of separation. Now, the advantage of a lump sum distribution is that you can spend or invest the balance as you wish, any which way you want. The problem with this approach is the fact that you have to pay all those tax dollars. Now, the question is, well, what kind of tax bracket are you in today? And do you foresee being in a higher tax bracket in the future? If that is the case, then it might make sense, to pay the taxes today as opposed to deferring the tax. Now, income taxes on the total distribution are taxed at your marginal income tax rate. So that's why it's so important to make certain that you understand what your deductions, your exemptions, and your credits are for the year in which you're going to take your lump sum distribution. If the distribution is large, it could easily move you into a higher tax bracket, and then obviously that would create other issues and concerns along those lines. Now, if you don't qualify for the options that we have just covered, or you don't want to pay current taxes on your lump sum distribution, you can always roll the money into a traditional IRA. Now, if you choose a rollover from a tax-deferred plan to a Roth IRA, if you're moving from a tax-deferred plan to a Roth IRA, then you must pay income taxes on the total amount converted in that year. Now, however, future withdrawals of earnings from a Roth IRA are free from federal income taxes after age 59 and a half, and as long as the 5-year holding rule requirement has been met for Roth IRAs. Now, even if you're not 59 and a half, your distribution may be tax-free if you're disabled or you happen to be a first-time home buyer. By the way, $10,000 is a lifetime maximum for that, and as long as you satisfy the 5-year holding period. Now, if you decide or you elect to use an IRA rollover, so you're going from a tax-qualified retirement plan and you're rolling that to an IRA, then you can avoid the tax penalty and problems by electing a direct trustee-to-trustee transfer. That means that the institution that holds your 401k today will do a rollover. Obviously, you'll have to do the paperwork, and it will roll that money over directly to the new institution, so it will bypass your hands, and by doing that, there's no 20% withholding period as it would be required otherwise. Now, always remember that you must generally begin taking annual required minimum distributions from your tax-deferred retirement plans after you turn 70 and a half, and we've had a number of podcasts along those lines. And also the first distribution must be taken no later than April 1st or April Fool's Day of the year after the year in which you reach 70 and a half. So in other words, if you turn 70 and a half sometime in 2017, you must make the first required minimum distribution by April 1st of 2018. Now, of course, there's always a possibility that you may be able to keep the funds in your former employer. Some employer retirement plans do force for you to take your money out because you're no longer employed with them, so they would like for you to take your money out either in a lump sum or you can roll it over to an IRA. So there are always a lot of issues and concerns that I get asked, and I try to jot these notes down so I can cover them with you. But those are things that are very critical for 2017 and 2018 and beyond. Because of the fact that the new tax laws are lower for the vast majority of Americans, it is a proper time to do tax planning, because if you do proper tax forward planning, then you're able to reduce your tax liability not only moving forward into the future, but most important, in retirement. And again, there are only 3 types of accounts that are totally tax-free, even under the new tax laws under the IRS code. And those are your Roth IRAs, your Roth 401ks, and your personal insurance and retirement programs. So obviously those are things that are very critical to understand, and this is where I do a lot of my planning with many of my clients along those lines, because you want to make certain that at the point in time that you retire, that you can reduce your tax liability to such a point that either you're going to pay a minimal amount of taxes to the IRS, or you will pay no taxes at all. And then obviously if we do proper provisional income calculation for you, and you have a few years before retirement, then we're able to also have your Social Security benefits become totally tax-free and non-taxable to you. So again, as I always say, our number one goal at Cambridge, and my number one goal, is to provide education not only through webinars and podcasts and our YouTube channel, because our number one job is to get you, the listener, to change the way that you see things. Because when you do change the way that you see things, interesting enough, the things that you see change. So again, thank you so much, and we'll talk again next week. Have a great day.